the MPC voted unanimously to keep the policy rate unchanged at 5.25 and retain the neutral policy stance. Professor Ram Singh, one of the committee members, voted to move the stance from neutral to accommodative, as he had done in the previous policy as well. So, from a stance perspective, it was a 5-1 vote, whereas for keeping interest rates at the current policy rates of 5.25, it was a unanimous vote. If you look at the major economic projections made in the current policy, we see some upward revision in the inflation projection. So, if you look at the Q4 inflation projection for FY26, it was revised upwards by 30 basis points from 2.9 to 3.2%. If you look at for FY27, largely a 10 basis increase in the H1 FY27 CPI projections, with one quarter inflation projection revised upwards to 3.9 to 4, and the Q2 projection increased from 4% to 4.2%. One of the reasons RBI gave on inflation, estimates was because of the low base effects. Because inflation was so low at the same time last year, it's leading to slight base effect, and that's why inflation, although month-on-month movement is not very high, but just on the base effect, inflation is expected to pick up moderately. Why inflation is expected to pick up, but if you look at the actual numbers, the Q1 and Q2 still close to RBI's target of 4%. So broadly, we do expect that RBI should remain comfortable with these inflation projections and continue to keep these policy rates lowered for longer. Um, Secondly, although RBI was supposed to give inflation projections probably for the Q3 of FY27 as well, as we know, there's a new CPS series coming on 12th of February, which is based on latest 2024 household consumer expenditure survey, and it will most likely reduce weightage towards food inflation and increase weightage towards more of core inflation. Even within food inflation, it is expected to reduce weightage towards cereals, and it is expected that weightage for protein items and milk and other products will increase. So overall, the trajectory of inflation, the nature of inflation will undergo a slight revision, and that's why RBI mentioned that they will probably provide their full year forecast in the April after studying the new inflation series. If you look at the growth estimates as well, as we know, the RBI policy happened after the announcement of US India trade resolution. We will discuss it in greater detail in the subsequent slides, but as we know, in the last 6 months, India was facing a very high tariff of 25% plus 25% penalty to because of buying of Russian oil. So the total tariff in effect for India at the headline level was 50%, and the effective tariff rate, because of some of the items were exempt, like pharmaceuticals and telephones, the effective tariff rate for India was 32.9%, which was of the highest in Asia. So when the announcement came of the resolution of US-India trade deal at 18%, and India also promised to stop buying Russian oil, so that penalty will also go away. Broadly, it was expected that that will lead to some amount of growth uptick. And as India has also signed the FTA with Eurozone in January, so now you have a very integrated market, which is a FTA already with the UK, with the Australia, with Europe now, and now it has a trade agreement with the US. So that's why it gives slightly higher confidence to RBI that economic activity is doing well. And signing of all these trade agreements, the economic activity should further pick up. Although the announcement of the US India trade deal was still a bit sketchy, and hence RBI has not assumed the growth estimate revision taking into account the US policy, but broadly they have taken into account the FTA signed with Eurozone. So as we know, they have revised the growth estimates target by 0.2% for each quarter of Q1 FY27 and Q2 FY27. So it goes from 6.7 to 6.9, 6 point, and 6.8 to 6. The bond market, before this policy was announced, was expecting RBI to cut CRR or infuse more liquidity measures, and that was disappointed. One of the reasons why market was anticipating RBI to give some liquidity measures at the current policy was that because of very tightness in money market rates. So for those of you may- tracking money market rates or who are just listening in, 1 year CD rates have gone up from 6.8 to 6.85% to all the way to 7.2% in the month of Jan. So money market rates have gone up significantly, and this is typically happening in Jan to March quarter in where yields spike up on credit growth. But investors were expecting RBI to announce some liquidity measures because at the absolute level these yields have become quite high. Just to give a perspective, last year when the policy rate was 6.5%, the 1 year review rate was around 7.5%. And when now the policy rates have gone from 6.5 to 5.25, the CD rates are just at 7.2. So not a material difference there. Hence, the, the, the banking community and the market participants were expecting RBI to announce something on liquidity, but RBI largely maintained status quo, and they assured the market that they will provide liquidity for all productive purposes whenever it's required by the market, whether in terms of OMO, whether in terms of FX price and swap, or BRR auctions. So RBI is ready to provide liquidity, but RBI thought that probably given that liquidity is already improved meaningfully, so from just about 60,000 crores now it's come to 3 lakh crores headline liquidity, RBI probably didn't need to do OMO to further boost our market. And that's why we saw some increase in bond yields of the day of Friday as well, when bond yields went up by 5 to 6 basis points. So the 10-year bond yield moved from 668 all the way till 675 as well, because market participants expected RBI to take some liquidity measures, which RBI rightfully, in our opinion, assumes that they've already done enough. And if you look at the overnight rate right now, it's already at 4.5 compared to the policy rate of 5 quarter. So the overnight rate in the interbank market is already 75 basis below the policy rate. And that's why probably RBI did not take any action on the liquidity front, but it assured the market that uh, whenever there is any dearth of liquidity, RBI will come and provide liquidity to all its operating channels. So, on a nutshell, policy largely remains status quo. The stance remains at neutral. The policy rates also remained at 5 quarter. Inflation, although was revised upwards, but RBI took comfort that largely it was due to base effect and not incremental price momentum pressures. On the growth front, RBI has taken comfort from the FTA signed with Europe and other countries, and hence RBI expects it to pick up in exports also. That's why the growth numbers were also surprised. But more importantly, while market looks at RBI for policy and its forecast, what we also need to evaluate RBI policy in terms of regulatory, you know, en- encouragement to banks to support credit growth as well. So if you look at this RBI policy, it brought some new reforms in the REIT-based lending. RBI allowed banks to lend to REITs. So far, under the current regulations, banks are not allowed to invest directly in REIT bonds. So they can lend at the SPV level, but they cannot buy bonds of REIT entities. Now, with this policy, RBI also allowed banks to buy REIT entities, which should improve liquidity in the REIT market, which would also lead to spread compression for REIT. So overall, a positive move by RBI. On the SME lending also, RBI has increased the collateral-free SME lending limit from 10 lakhs to 50 lakhs. Given that now the last 3 4 years, the size of the economy is also grown, size of the MSME is also grown, and that's why they've increased the limit at that level. And that's why, so if you look at the policy just from a interest rate lens, probably it was neutral. But if you look at the policy from a regulatory lens, I would say the policy was quite accommodative. They promoted EOV business for smaller NBFCs. They gave benefits, to the REITs that their bonds can be bought by the various banks, and they also gave relaxation to the banking system, other channels. So broadly, the accommodative policy from regulatory standpoint. And even on the interest rate standpoint, it continues to remain well anchored towards 5 quarter. We think at least for next 6 to 9 months, interest rates could remain at these current levels.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.